A large company has to be a small, successful company first. And then can it be a medium-sized successful company? Then eventually, hopefully, it can be a large, successful company. So it started, can we be a small, successful company? And it really comes down to, am I solving an important problem? It actually has to be not just important, it has to be kind of urgent. It has to be really painful for the customer.
Hello, everyone, and welcome to Built Not Born, the startup go-to-market podcast by Venture Guides. I'm Sage Nye, and around here, we believe that great companies are built, not born, one smart decision at a time. Each week, we take you through real conversations with founders, investors, and go-to-market experts on what it really takes to land customers and scale your startup. Now, let's get to work. Hello, and welcome to Built Not Born, where we dive into the real stories behind startup execution, venture capital, and go-to-market strategy. I'm Sage Nye, partner at Venture Guides. Today's guest is very exciting. He has spent the better part of 3 decades at the intersection of venture capital, cybersecurity, and executive leadership. I'm very excited to announce that Dave Fischetti is a partner at Venture Guides, a seed stage firm focused on helping early stage founders navigate the path from idea to growth. He has also had recent experience as the chief strategy officer at BitSight, a leader in cyber risk intelligence, where he oversees corporate strategy, strategic partnership, and M&A. That dual role, operator and investor, is really the through line of his entire career. Dave also spent 2 decades as managing director at Globespan Capital Partners, where he was part of the firm from its very inception, focusing on enterprise software and cybersecurity investments. During that time, he backed and served on the boards of companies that were acquired by some of the biggest names in technology: IBM, Google, Citrix, and Pegasystems, among others. But Dave's story really doesn't start in venture capital. He's an operator at heart. Early in his career, he was part of the executive team at Family Education Network, where he helped grow the company to over 4 million monthly visitors and a national network of more than 10,000 schools. Before the company was acquired by Pearson PLC for $175 million. Before that, he was building businesses internationally at Transnational Group, and he began his career at PricewaterhouseCoopers working with early-stage, high-growth companies. If you want to hear from someone who has a long career of both investing and operating, this is for you. So, Dave, welcome to the show.
Thank you. Thank you, Sage.
We are very excited to have you here, both on the show and also at Venture Guides.
I am very excited for both those opportunities as well.
I would love to start with a little bit of your own background. Can you tell the audience about yourself? Yeah,
sure. I mean, as you mentioned, I've had a very long career. I'd like to think that I'm not as old as I am, but that I have the benefit of that experience. About 40 years now, almost evenly split between operating roles and investor roles, and I guess I just can't decide. I find them both fascinating for very different reasons. But early in my career at Pricewaterhouse, in the late 80s, we actually had an office in Cambridge called the Entrepreneurial Services Center. And I got the bug, and I've just been excited about just being around the excitement of that early stage of growing a business, starting to see, the product market fit, getting those first customers. I find it's a passion of mine. But I do find there are pluses and minuses each side, and we can talk about that. And I feel like on the margin, I am probably a better investor than I am operator. And if you look at my operating roles, I cheat a little bit because I get in roles that aren't operationally intense. Like head of strategy is very similar in a lot of ways to what we do in venture capital.
I actually do want to start with the burning question, which is, you have had such an incredible career and you have been an operator and an investor. You just joined us here at Venture Guides. Why did you join us?
So great question. Look, I found that success has a couple of components to it. Obviously, there's skill set, there's capabilities, there's a space you're in, and then there's the people you work with. And, I've known the team for a very long time here, not just, in a social aspect, but we work together. I was an investor and involved in the board on Turbonomic. And a lot of the team here, we all share that history together. And in like many companies, a very successful outcome, a couple $1 billion that IBM paid for that. And actually, IBM has acquired 5 of my portfolio companies, so thank you, IBM. But like a lot of opportunities, it was not linear. I mean, there's ups and downs. And I think when you deal with the complexity of the down and the challenges, and you navigate through that with people, then you really know these are people you can trust and you're going to be working with well together. And that was sort of when I thought about coming back into venture capital and I looked at where would I do that? It was obvious to me that not just because of the people, but the space that Venture Guides in infrastructure software, I've spent the majority of my career there. And then also the stage. Again, you come back to this, this is where you can have so much impact at the stage that Venture Guides is investing in. And then I guess the last thing I would say is that having spent time on both the operational side and the investor side, a lot of investors, everyone says the same thing. You reach out to me, I'll help you here, I'll help you there. I used to find that actually in the majority of my companies, I was the first call. And there's a lot of reasons we can talk about why that is, but I think that's important. And then, Venture Guides takes it a step further and actually puts some structure on what does that mean to support with VG sales and the things that we do. And so I thought in this market where you need to be very differentiated when you go out and you compete for business. I mean, it's unusual that you're actually competing to write a check to somebody, but that's the business we're in. And you need to be able to differentiate yourself and why they should take your money.
I'm curious, you say that you were the first call. Do you feel like your experience as an operator and the fact that you can really empathize with founders has led to that first call? Or
No, there are two things. One, and this goes back to the operational. One of the reasons that I think venture capital works well for me is I wrestle with decisions. And the reason I wrestle with decisions is because I like the optionality and I like to think through what the multiple sides of what happens if you do it, if you don't do it. And venture capital, the nice thing about that is you only have to make a small number of really important decisions. So
they're pretty important.
They're really important. But that actually works to my advantage because I will overanalyze.
Okay.
And that's really good when you're making a really hard decision. It's not good for every decision you have. I mean, I learned this early in my operating career. I was running a half of that startup at Family Education Network. I actually had two co-founders. The CEO I reported, the other co-founder reported to me. And we went from maybe 20 people to 220 people at a point. This is back right in the middle of the internet bubble. I had about 80 people reporting to me. And for whatever reason, I was on the opposite side of the office as was the CEO. And literally between me walking to his office and back to mine, I would make like 8 decisions. People saw me, Dave, can we do this? And I would make all these decisions. I'd back to my office and say, why did I agree with that? And I walk back and say, hey, I might, and they go, Dave, you can't back it. I've already started to put that into motion. So that's weighs on the CEO. But when the CEO calls me and says, Dave, I just really need a little bit of advice here, and starts to describe the challenge that he or she is dealing with. And what I would say is, okay, well, look, I understand what you're asking. So first, you mentioned empathy. Empathy is critical here. So I understand where you are. I feel your pain. Let me describe to you what you just described to me. You got to turn, you got to make. Do you go left? Do you go right? Well, let me tell you what I think left might look like. And then let me tell you what right might look like. And then I leave that with that's your decision to make. I actually don't care which way you go. And if you're right, I'm happy for you. If you're wrong, I'm disappointed. That's too bad for both of us. But I don't judge you differently because, you didn't take my advice and you were wrong. It doesn't matter what decision. It's really your decision. And you have to be super clear about that. It's a really hard role to be CEO, and that's important for them. And I think that's why they feel like, okay, I trust Dave. He's not going to judge me. He's going to help me. And that's important.
And I think that brings up such an important point that we talk about at Venture Guides, which is that ultimately we don't run the company. The CEO runs the company. Right. So we can give you all the data that we have, all the advice that we have, but it is your decision at the end of the day.
It is. And I'll give you one because it comes up, because we do. I mean, we are helping these companies quite a bit. And so the question becomes, when you think about that, you have this governance role, you have a support role. And sometimes companies like to keep that distance. Like, I don't know how much I want to get the board involved. And I think that the way you do that, and keep in mind, for me at BitSight, just to be very clear, when I came in to run, strategy for the company, I was the largest investor in the company. So the CEO had to get comfortable. And I'll tell you the way you have to think about this, because the CEO and I talked about, should I come on board and can I help the company do? We had a market strategy issue. The market was coming to say, hey, everybody wanted to do. We came out of the gates really fast. Yeah. When I met the company, there were 3 people. When I invested, there were 15. By the time I joined, there were about 150 people, and the company was growing at like 400% per year. And everybody kept coming and say, we want to do something with you. And in other words, we should be working together. Well, what? How? What should we be doing together? And we couldn't find the right person. We found that people were either corporate development or business development. And we really wanted someone in strategic partnership ecosystem development. And we just couldn't find the right person. And I was interviewing people. And so I said to the CEO, I would do it. And when I first said it to him, I felt like he ignored me. Anyways, he came back to me the next day. He said, were you serious? And I said, yeah, I'll do it. And so what we had to decide was, and he and I worked together very well, but we had a president this was a go-to-market function. And we had a president who I knew very well because both of these people were at a company that I had been on the board of. And the question was, where was my ego? Because it was a go-to-market function. And for me to report to the CEO in a go-to-market function would be dysfunctional. And dysfunction kills companies. I reported to the president. Could you imagine the president now of the company? So the president reports to the CEO reports to the board. I'm the largest investor on the board. You cannot accomplish that without tremendous trust. Which hat am I wearing today? And when I was on the board, it was the governance hat. And when I was in the operation, it was the operation. Not only did we achieve that with the CEO that I first did it, because we promoted that president of the CEO. I worked for him. We're at over $200 million in revenue now with 3,500 customers. We brought a new CEO. But just to give you a sense, that's the trust that you need to build when you're working with an entrepreneur. And it's really important. And if you build that trust, it pays dividends for both sides.
That's amazing. I think it speaks massively to your own lack of ego and the ability to build trust, I also think it speaks very well to the CEO to recognize I have an opportunity to bring on someone who's really talented. Yes, there's some hair on it. Yes, it's complicated, but I'm willing to take the leap to do the best thing for the business and for the company and the customers to try it. It does make me wonder when we think about management teams, I would say across GlobeSpan, BitSite, Venture Guides, all of the different roles you've played, you've met with very young management teams and companies. Two questions, actually. First, how do you think about what makes a good company? And then tied to that, because people make companies, how do you think about what makes a good management team?
So let's start with the company. So to me, I mean, you really have, product market fit is everything. Like there's only a few things you have to really get right. And then the rest of it's just yield. So I would say there's efficacy and there's efficiency. I'm not convinced efficiency, not that every startup is a snowflake, but there's a lot of trial and error, as you know. And so I focus first on efficacy. Can we be successful? And then I'd love to figure out how successful it can be. And we can define, what is success. And that's why I go back to my earlier point about incrementing. A large company has to be a small, successful company first. And then can it be a medium-sized successful company? And then eventually, hopefully, it can be a large, successful company. So it started, can we be a small, successful company? And it really comes down to, am I solving an important problem? It actually has to be not just important, it has to be kind of urgent. It has to be it has to be really painful for the customer, and I'm talking about business to business solutions. So the reason it has to be painful is because the last thing they want to do is deal with a startup. It has to be an important and hard problem. So that you have to start there. Now, it'd be nice if that can expand into, we talk about, can you be a very targeted solution, a point solution that can expand into a platform? And what I want to do is solve the hardest problem first. And if you solve that hard problem first, you can earn your right into the other problems. And then you can expand with it. And that's beautiful because everybody loves, that, you get everybody focused on net retention, which is really just, gross retention is the customer satisfied. Net retention is, do you have a portfolio of things you can sell at a satisfied customer? And so that's sort of at the company level. So that's the company. And then the people, when you look at a team, and again, we're investing very early and, the team might be 2 people. I look at an entrepreneur and I ask myself, does this entrepreneur know what they don't know? Because there's a lot of stuff we all, and that actually is a test of a couple of things. You're testing someone's confidence in their own ability. You're testing their curiosity. You're testing their collaborative nature. And it's a very easy test. And so when I'm talking to an entrepreneur and I'm listening, and what I'm really listening for is, do they know what they know and what they don't know? And what happens is, if they don't know what they don't know, you will usually find that in 2 ways. One is they will make a big deal about what they know. And then they will be very dismissive for a variety of reasons of what they don't know. Like you ask, what do you think about? Oh, that's not, we don't have to deal with that. Or, that's not going to be, it's not going to be an issue with us. Or no, because we do this. Like, okay, but what if this comes up? No, it's not going to come up. Well, how do you know it's not going to come up? I mean, so I find that what I love when I'm talking to an entrepreneur, they're very excited about it, they're very proud, they know what they know. And the other thing is, by the way, and it's okay to say this too, which is, I don't know that, but here's what I'm comfortable with, that I don't think we'll have to deal with that for a little bit of time. So I can tell you that I'm not worried about it right now, and I feel confident that I can, but I know it's out there. It's a known risk, but it's not an immediate risk. And so that's a good conversation. And then the second thing I look for is, how is the team together? How are they engaging with each other? Is the one founder dominating the conversation? Are they respectful to each other? Are they playing off of each other? Which is great when they are. So those are the couple things that I'm looking for in the team. So to the domain experience, intellectual curiosity. Unfortunately, the world is becoming increasingly complex. You look at AI and all the things that are going on, and so intellectual horsepower is becoming more critical than ever. And so anyways, those are the kinds of things I'm looking for.
That makes a lot of sense. Are there any red flags for you where you say, okay, if I see this in a meeting, even if everything else has gone well, there is absolutely no way I'm proceeding? Yeah,
I mean, stubbornness is. I actually used to say, great entrepreneurs are resilient and tenacious, but not stubborn. It's not actually true. They are stubborn as well.
I was going to say.
I think the 2 of my favorite entrepreneurs, Nir Zook from Palo Alto Networks. We were a very early investor, pre-revenue in Palo Alto Networks, and Anthony Wood at Roku. Both very successful founders, both a little stubborn. But they had reason to be. I mean, this goes back to the point about Nir Zook. He understood the problem in firewalls, and he understood it pretty broadly because he had multiple companies. He had a Checkpoint, NetScreen. He really understood the problem. And I always say to people, when we made that investment, he better be right because he's not changing his mind. He's very successful, and he would listen. I mean, I had him on a panel in one of our limited partner meetings. He was more willing to listen than you would think, but he was very committed. He had a lot of conviction in what he's doing. And obviously, you can see the outcome of that. And Anthony Wood, the same way. But they, in both cases, as experienced and as confident as they were open to listening. And that's the key. And if I'm with an entrepreneur and they just don't want to listen, that's not going to end well. And so I feel that's an easy no right out of the gate.
I think that makes a lot of sense. One thing that it's so hard to figure out is leadership styles. And a strong, healthy leader can get so much more out of their team than, I would say, a weaker leader. Do you have anything that you look for there in terms of how people are? You mentioned the team playing off each other, but how a team is interacting or how the leader thinks about leading?
Yeah. I mean, a leader, the mountain is steep. And so you have to both cajole and you have to push and you have to lead from the front. And if you notice today, which I find interesting, is that the leader you have to embrace the technology. I mean, I think it's increasingly, if you look at it today, especially with all the social media and LinkedIn has become, when I first joined LinkedIn, it was just a networking application. It's just like any other social media today. But you look at CEOs, they're leading from the front. I mean, they're talking about the specifics of the problem. Your team has to be confident that, in that very competitive environment, you guys are going to show up and you're going to win. And I think that starts with the leader. And so that is a very out in front. This is where a risk-taking and just aggressive, respectful, but aggressive behavior. But I do think people want to know we're going to win. And that starts with, can they see that in the leader, that they're in a genuine way that they're following?
That makes a lot of sense. Switching gears a little bit, because you've not only looked at companies as an investor, but also in your role as chief strategy officer. Is there a difference when you're looking at a company from a sort of strategic perspective as opposed to as a potential investment?
Yeah, there's some things that are very common. Again, I'm looking, so we've been very, we've made 4 acquisitions at BitSight. We've been very successful in those acquisitions. I pride myself on the length of time the CEOs stay with us. In fact, in our most recent one, and he's a very good friend of mine now, the CEO. So the difference is, I'm trying to figure out, I have a platform now. BitSight is 3,500 customers across. We have 5 solutions in our product portfolio that our customers buy. And so what I'm looking at is, how do I enhance those? I'm not looking just to add a 6th product. The beauty of our business is it's a data business. Mm-hmm. And so what I'm really looking for is data assets that I can quickly integrate. And then the question becomes, what additional skill sets do I need beyond that? Like, for example, when we bought this company in Cyber 6 Skill in the threat space, they also brought a tremendous AI capability, which we needed more broadly. The reality is, you're buying something for what it can do for you, not what it's done to date. And so and you need those people to do that.
Interesting.
But I'm looking at, how do I augment a capability? So on the one hand, I need to know the technical prowess. I need to know that they understand product market fit, all the things we just talked about. But I don't need necessarily to know the breadth of what it can do. I need to know what it can do for us. And I will value it. And that's always the negotiation, is I'll value it for what it can do for us. And, the thing I often enjoy when someone says to me afterwards, and they, wink, wink, I would have taken less. I say, well, good news. I would have paid more. So I guess we got a good deal. Because, it's a long-term thing. Because again, if you can't get that in, a lot of acquisitions fail for this reason. If you can't get that in and get it productive and get it integrated, then you failed. And that's about people, that's about relationships. So you have to balance both the transaction itself with, what do you intend to do long-term? So there's similarities. There are a fair amount of differences between the two.
That's fascinating. If you were talking to a founder who's trying to think about acquisition offer, what advice would you give them with that in mind?
So I give them the same advice if they take our money, which is, when you're dealing with other people and you're dealing in a relationship business, you've got to know that these are people you want to be with. Mm-hmm. Like, it's the same thing in acquisition. It's not, again, you're going to be asked to stay some for 2 years. The thing about all of this is, time is the most scarce resource we all have. You do not get that back. And so you really, if you're going to spend 2 years there, somebody says, if it's enough money, it's worth it. 2 years of your life. And by the way, you should have choice. If you've done a great job and you've built a really good business, you're going to have a lot of options. So the key there is, you don't build a company to be acquired, but the reality is that is one of the 2 great outcomes. And so if you take other people's money, then, particularly venture money, you are on one of those 2 paths. Yep. It's not a lifestyle business. And so you're going to build so that you fit within ecosystems. You should have partnerships. I think partnerships are a great way to find eventual acquirers. I mean, like a number of the companies that Cyber 6 Skill, we were a customer of a third-party trust who we acquired. We had 30 joint customers when we acquired the company.
Wow.
Anubis Networks we acquired. That was our best data source. We knew that there was, value there. And so I think that the best outcome is when you're ready to walk. The majority of negotiations I'm in, at some point in that conversation, say, we're not going to get this done. And that's okay, because I play the long game. We'll see each other at some other point. And when I say that, I'm not bluffing. Like, I'm ready to go. And you need to be able to do that, which means you need to be comfortable with your, the BATNA, the best alternative. You need to be comfortable with that. And so I think for the founders, and for the entrepreneurs that are navigating, If it's a really good deal with someone you want to spend time with, you should take it. I mean, if the company is struggling and failing, that's a different conversation.
Yeah.
If you build something of interest, you have options.
That sounds great. And the alternative to your point is, so you should take it or just keep building.
Just keep building.
Because you want to be in a position where you can just keep building.
That is your best alternative. Like when you're negotiating and someone's saying, well, there's no one in the other room. There doesn't have to be somebody in the other room. Like the alternative to you is that we keep going, and we're pretty excited about that.
When we think about the investing world today and the market that we're facing, it feels like it's moving so fast and everything is changing so quickly. Now that you're in this role at Venture Guides, are there any nuances that you're looking for or anything new that you're looking for in management teams?
You're right. I mean, and people compare this a little bit to the internet. I mean, I went through that experience as well. This is very different. This is an entire technology shift. And anytime you change the base of a technology, I think of this as, the LLM is the equivalent of a new operating system and everything. That means everything that's on it or around it has to change. And it's just changing so fast. Where is the safe ground? And it's not, it's not really clear. And so number one, AI native, everything has to start with that. And then I think beyond that, I do think that, what I'd like to think, there's a first order problems that come from any change. And I think there's a strategy that's in the market today that I don't agree with. I mean, there's nothing wrong with it. I have some friends that are in other firms that are executing very well. And the strategy is this, which is it's a first order problem. It's got a big flashlight on it. I'm going to take a very, very talented team and I'm going to pour a whole bunch of money into the company and we're going to run really fast. Our competitive differentiation, we're just going to get there faster than anybody else. I actually prefer an alternative strategy to that, which is to say, okay, when those first order problems are solved, what's the second order problem? What problem does that create? Can we at least think a little bit about what the world might look like in 3 years? And can we get entrepreneurs that are focused on that? And so, what might be a little bit of an edge case today, but we think that'll move more mainstream, that becomes very interesting because it gives you running time. Like you can actually think it through, you can test it, you can put an appropriate amount of capital deployed against it. I think that is a way better place for us in the way we're set up to spend time. And I think there's some firms that will be very successful in that first strategy, and I all credit to them.
Yeah.
But I just think there's so many spaces that's not true. And so I don't think there's any dearth of opportunity for funds if they're focused. I just think there's a lot of lemoning.
I have a question to that on that line as well, which is, there's a lot of firms now that are going to find students that have just dropped out of college and they're trying to give them crazy amounts of money at crazy valuations for a young, unproven founding team who has a lot of learning to do between now and then.
Right.
If you were advising some of these teams, how would you advise them to think about, do I take the $50 million check, $20 million check, or do I think about the, $5 million check with a firm that maybe is going to have more focus on me or more of a partner or something like that?
I do think experience matters. You have to be careful. I always think there's correlation and causation, right? Mm-hmm. And let's not confuse the two. Yes, there's correlation. A lot of people that drop out of school, I think the experience matters. And I think you can gain that experience very quickly. It's not like you have to go. I always say, like when I was in the internet company, my average person that was working for me was 26 years old, and all their friends were vice presidents. So they would come to me and say, "I should be a vice president." I said, "Why?" By the way, I was 34, and they were telling me I was age discriminating. And so I said to them, I said, "Look, it's very simple to me. There's a set of gates you got to go through. I don't care if you get through one a day, but there's a set of experience gates that will help you be more successful in the role that you want to get into, and you need to get through those." And so what I would say, there's two choices for a young entrepreneur. One is that you work with someone that can really help you, and you go after something in stages. Let's get something, let's get the first problem solved, and then we can get the second problem solved. The second is you align yourself with someone that's navigated before. So when I met the team at BitSight, the reason I met them is they were interviewing the CEO of one of my other portfolio companies. The guy was 68 years old, and this is in a published article, so I'm not telling you anything that's not in the market. He was worth over $100 million. He had been a CEO very successfully 3 times. And they called me and they said, and these guys were they were over at MIT Sloan. They were in their, I think, mid to late 30s. And they called me and said, "Hey, we're thinking about hiring this person. What do you think?" And I said, "Well, listen, I have to tell you 2 things about him. One is he is incredibly successful, and he's got houses all over the world. You're not going to get all of his time in the office, but you will get his mental time, and that's invaluable. And the second thing I have to tell you is he's fired at least one of the co-founders at every one of his prior companies, and they hired him. That's part of the reason I decided that the courage they had to make the right choice, not putting themselves in front of what they were trying to accomplish. I said, these are 2 courageous entrepreneurs, and I'm going to back them." So what they did was they hired someone. This is actually a study at Harvard. I think you want to have people around you helping you navigate, whether it's someone on your team that you're the number 2 the first time out and you have a huge success, you'd be number 1 the second time, or whether you have someone like us. Because the benefit you have if you're a younger entrepreneur and you want to be in a lead position is you need time. You will most likely make a great decision, but you're going to need more time to make that decision because you don't have the benefit of all the prior experience. And so you ask yourself, where can I put myself in a situation where I get a little bit more time that I can make that decision in?
Yeah. And I think to that point, as you think about building a team and helping have leverage as you're making decisions and stuff like that, it can be really hard, but also really scary to build your first team as a founder because it's the first time you're starting to let go of functions.
Right.
And it's critical. You need to have some scale, but you also want to make sure that you know what's going on in the business. So how do you advise CEOs, or how do you think about empowering a team, but also staying on top of what's going on without micromanaging?
Yeah. Well, I think you have to look at it. So you need a team, right? And so this is a team sport.
Yep.
And the way I think about it, it's actually the same way I evaluate teams, depending on it. So I have each of the roles that you would need. And then across the top, so that's the y-axis. And on the x-axis, I have domain, I have function, I have scale, I have life cycle experience. So have you gone through this before? Because there are patterns. It's not random. And then soft skills. Are these good people? Are they collaborative? Are they, ego in check? But if I go through that, and then what I say to, and I would say this to a CEO starting out, this is what you got to fill out. And what you want to do is you want to check to see sort of every time you can't check something, then you've got a risk. It doesn't mean you shouldn't take that risk, but you want to look and say, in the function, I have a head of engineering. How confident that I have someone that can scale? They're good enough to do the job today. And by the way, it's probably an okay answer if they're good enough for the next year or two. Look, not everybody scales. And as a CEO, you've got to make that decision. And so my point to you is the team construction is an evolutionary, it's a living thing. And so you start off, and I like to look and say, what roles do I need? When do I need them? You don't need them all right at day one. But as a CEO, it's a beautiful thing to delegate. It's like, wow. And by the way, you delegate to the team and you get credit for it anyways. I always say, that great leadership is, there's a couple rules I live by. Number one is never criticize in public. If you have something to say, close the door and have that conversation. Always compliment in public and always compliment your team. Anytime you're in a situation where you're with a board and you say, well, the team did this, and give them that visibility. Because the reality is, if your team did it, you did it. So you don't need to take credit for it and let the team take credit for it. And so I do think that that's important. And again, I think that building that kind of motion, it's just a flywheel if you get it right.
Amazing. So that's the getting it right side. If you were to say across your whole career, is there one mistake that's really stood out that you would recommend other people watch out for?
So, some of this, I'm an experiential learner. And the positive of that is if you do things that you get to repeat yourself, venture capital is a good example of that because you get to actually make another investment. The negative of that is it's very painful when you make those mistakes. And there's no safe investment. And I made a safe investment early in my career. I thought I was making a safe. I had two choices. And one of them is a company that went public here in the Boston market. I didn't choose that one. And I was getting a lot of pushback from my partners. And there's a question of the strategy. And I respect that. That's the way all these deals are. The other one was a very focused investment. And there were two flags that I got in due diligence that I ignored. I just chose to minimize them. One was on the CEO. There were some clear signs. This came up later where he would be, so we would talk about customer fit and he would say, well, they don't understand. Well, the customer usually does, does understand. And the other was, I got some feedback. It was a database company. And I got some feedback that technical founder was very strong, but only on certain kinds of databases. And it was meant to be a capability that was across a broad set of database technologies. And I got some feedback that there were some things that would be limited on. And I thought, that's not going to be a big deal. And so I made the investment. So the two mistakes I made is I made the investment, which I shouldn't have. And I was doing both at the same time. And part of it was just I had too many things going on with the other one that I just, so I said, I'm going to focus on this one, do it. So I made the investment. The second and bigger mistake I made was at some point I had to fire the CEO. So I did. And I went and I ran the company. And it was a $3 million investment. And the reality is that the writing was on the wall, and I would have saved everybody a lot of time, including myself.
And time is your most precious asset.
And time is the precious asset. And so two mistakes in one.
Fascinating. Dave, I wish we could keep going all day, but at some point we need to get back to our actual jobs here at Venture Guides. So thank you so much for joining. Before we wrap up, I have a couple reflective questions for you just to give some founders and our listeners something to take back. The first one's probably going to be the hardest question of the day. But if I had to ask, what is one of your favorite memories across all of the companies that you've worked with in your career?
Oh, favorite memories.
Told you it'd be hard.
Wow. I'll tell you one of my favorite memories, and I'll tell you why it's my favorite memory. So when I invested, and this is a story that's probably been out there in the market. So I invested in a company called Q1 Labs, and we had a pivot. And there was a point in time where most of the investors were sold that company for cash back. And the CEO, who was very dedicated, super experienced, and he and I talked a lot about it, and we had a couple other people there, and we made a pivot in the company. He actually led, to his credit, because he was worried about the amount of cash. And I said, there's enough cash. I know where the cash is. And he said, but it's not on my balance sheet. And so I said, well, we're not going to do it right now. He calls me the next day and says, we have a lead for a new round. And it was him. So I said, look, if he's going to put his money in, well, I can't deny that. So we put some money in the company. And then the company started to grow, and I was spending a lot of time with it, and some of the other investors weren't. And I actually led another round and actually increased my ownership in the company. We sold that company, one of the ones to IBM, very successfully. So when he called me to tell me that we're at the point where we have a term sheet that we're going to sign, that was just like, wow. And to the credit, and this is my little plug for IBM. IBM, because I've done this 5 times now, they show up with a lot of people, but they do what they say they're going to do. They're a very respectful buyer. Mm-hmm. And we sold this company in the time where the market created, we didn't create it, but in 2011, the market dropped during the due diligence period. So we had a signed term sheet, which was exactly what we want. Just to be very clear, we had a couple offers that were just not interesting to us. And IBM, to their credit, stepped up. I think they were very, very happy in it because post-acquisition was very successful, and they consolidated all their security around the team there. But they signed a term sheet, which was, I literally had a guy from corporate development call and said, we're using the word transformational here, and we don't like that word. And then the market dropped. Their stock dropped 15% during the period to close. They never blinked. They never came back and retraded. They closed that deal. They did everything they said they were going to do, and I have respect to that. But just having been at the low, and of course it can be much lower. We didn't close the company. But having been through that and to get that was just to have him call me and say, we've got it, we're ready to sign. And I just thought, well, you know what? That's what this is about.
Well, and to have an entrepreneur who's so bought in that he's literally bought in.
Yeah. Yes.
And then a win like that is so great. Amazing. Okay. What is one piece of advice that you would give a first-time founder who just started their company?
Can I give 2? Can I?
Yeah.
2. So 2 pieces of advice. The one thing that you have to appreciate, these are related. Cap table only adds up to 100%. That is a law of physics. And you need to manage that cap table as an entrepreneur. It seems so easy in the early days. Give this away, give that away. I'll raise some money. Your point about I'll raise a lot of money. Managing that cap table for you as a founder, for your employees, and for all of your investors that have different relationships with you along the journey is super important. Like what you mentioned, when I buy a company, I don't start at the top with the price. I actually start with the 4 constituencies. I start with the preferred investors. What do they need? With the founders, what do they need? What do the employee shareholders need? And what's the common? And I actually think about those 4 audiences, and I build up from that. And that's how I get to a price. And it's the same thing. Like if you're a founder and you're navigating, so that's number 1 is think about in your mind, what does this look like over time? What decision I make today? Because those decisions, you're locked into those decisions. That's number 1. And number 2 is when you take all these people money, you take them with you. And people that can add value to you are critical to you early. As you get later, you probably don't need as much. So I think about value add money, neutral money, and negative money. There's a lot of negative money in the market. And what I can tell you is I've been on 20 boards and I've made 100 investments. And cohesiveness between the team and the board doesn't guarantee success. If it's dysfunction, guarantees failure. So be careful about those quote. 2 things.
Dave, this has been really helpful and amazing for our listeners. There's so many insights that I'm excited to listen to multiple times over. I'm sure our listeners will as well. If people want to learn more about you, where can they go to do that?
Well, the internet is a pretty transparent place. You can search that. There's a lot of history of me on there. I'd like to think it's all positive. You might find something negative. I haven't been able to find it. But there actually literally is a website. I can't remember the name of it now. But in 2008 or 9, we had a thing on the most loved VCs. They had 50 listed. I was on it. So I feel pretty good about that.
Congratulations.
But look, I'm here. It's dave@ventureguides.com. Can't be any harder than that. And so, Sage, I really appreciate you spending the time with me. I think this has been awesome. And I'm so excited to be here. It's a great team. If you're raising a seed or Series A, you should come here.
Well, we are so excited to have you on our team and so excited for all that you can teach and share with the founders that we have in our portfolio as well. So thank you. And thank you, listeners, for joining us on Built Not Born, the podcast where we break down the real stories of startup execution. If you enjoyed this conversation with Dave Fischetti, first of all, reach out to him, but also be sure to subscribe and leave a review. And if you're a founder looking for guidance on scaling your startup, check out ventureguides.com. Thank you so much. Now let's get to work. Built Not Born, the Startup Go-to-Market podcast, is brought to you by Venture Guides. To find out more about Venture Guides and how our Venture Capital Plus guiding model helps early-stage startups build scalable go-to-market strategies and grow faster, visit ventureguides.com. And then make sure to search for Built Not Born in Apple Podcasts, Spotify, YouTube Podcasts, or anywhere else that you listen. Hit subscribe so you don't miss any future episodes, and we look forward to building with you. On behalf of the team here at Venture Guides, thanks for listening. Until next time, keep building.